In this video on the income statements, we're going to now discuss a little bit about how income statements look different for services firms. So far, we have looked at primarily the manufacturing set of firms and discussed the statements with respect to them. Let's just take an example of a couple of services firms. We'll look at an IT firm, we'll look at a bank to understand how the financial statements look slightly different for them, right? And obviously because of that the analysis changes a little bit when you look at services firms. There are some nuances which are higher. For example, services firms will typically not have any raw material cost, or in case they have, that will be very little as a component. What would be the biggest cost for a services firm? You would typically find services firm have a lot of employees because that's what they're basically basing their service on. So primarily employee cost becomes the biggest component of cost whenever you are looking at a services firm in terms of your analysis, right? So there are going to be some line items which are different when we look at income statements of services firms. For example, there is no raw material cost usually. Primary cost becomes employee cost. Excise duty also gets removed. Remember, excise duty was the duty you were paying on manufacturing essentially. So that gets returned as well, removed as well from the income statements. So anything that is to do with the manufacturing goes away and services comes in. In fact, typically while companies may or may not report it, here they should be seeing a service tax component that comes in, right? So that's what's the deal with service firms. Now let's look at a company like Infosys and quickly look at what the statement looks like. So typically we have income from software services and products. So these are whatever services they have, income from those services. Other income, the definition of other income stays the same. Total revenue is A plus B. In expenses, you will find that out of total expenses of about 39,000 crore, the biggest expense is employee expense, right? Then you have some other expenses that come in, which is again you will see the headers will be slightly different. Other than your depreciation and amortization expense, you see the headers are travel expenses, cost of technical subcontractors. We'll look at the bigger ones only, the major ones, other expenses, and then cost of software packages. So everything specific to the in information technology industry, IT industry, right? That's what comes here. And then they have the profit before business, and then they have the tax, and then the earnings per share. So everything else is exactly the same or similar as the earlier cases, just that the headers are different. One of the key differences is that employee cost is higher, right? And you do not have no you do not have excise duty, right? And typically some of the other headers are also different. They're more oriented towards service firms, right? uh, EPS calculation, rest of the definitions remain similar. In certain kind of services firms, the definition of operating profit, etc., get different, right? In this case, it is simple. You can consider EBITDA or EBITDA as the operating profit. But in certain other cases, you will realize that those definitions may not exactly hold, right? What would those areas be? Let's take the income statement, for example, for a bank. Now, how does a bank make money? The bank basically takes deposits, and on these deposits, it pays interest, right? On the other hand, it extends loans, and on these loans, it gets interest, right? So primary income is interest income. Primary expense will be interest expense. So that's your interest earned, that's your interest expended, right? These are going to be your primary incomes and expenditures that come in. The other income for a bank is all the other income that comes in the form of commissions, right? Or in their investment banking division, or when you use an ATM, you end up paying a fee to the bank, that kind of a fee. So all sorts of fee income, etc. If you ask for a new checkbook, there is a fee. If you ask for a new debit card, there is a fee. All that comes under other income, right? So these are the three biggest headers for a bank. You have interest income, you have interest expended. Sometimes A and B are put together. So A minus B, which is interest earned minus interest expenses, is something called as net interest income for a bank. So sometimes banks just report net interest income straight away, right? And so that is something that could come, which is interest earned minus interest expended. That is net interest income. Other income, as we saw, is commission, etc. Then all other operating expenses come here, in which you will get all the rents, all the employee salary, and so on and so forth. Right? All these costs come under the operating expenses. We see one more header, which is called provisions and contingencies. Now banks give out loans. These loans can turn into bad debts, which means they do not come back. Banks have to, by regulation, provide for these. What do we mean by provide for these? Every quarter, some part of their profit mandatorily has to be put aside as provisions and contingencies against these bad debts. These bad debts in the banking terminology are known as NPA or non-performing assets. Right? These are assets that they have extended as loans to other parties, but these will not come back typically. Right? Rest of the stuff remains similar, but in the context of a bank, you typically do not have what is called as an operating profit. That concept is not very clear as to what is an operating profit. Does it have to be profit before provisions? Does it have to be profit after provisions? That data point is not very clear, and hence that becomes an important consideration when you're looking at banks as such, right? So that's the difference when you look at a services firm versus a manufacturing firm in terms of what kind of income statements they would have. Those are the primary differences, as we've already seen in the case of Infosys and in the case of Yes Bank. What could other services firms be? Hotel firms are services firms. Retail companies are services companies. Airline companies are services companies. Consulting firms are services companies, right? Education firms are services companies. Tourism travel firms are services firms. So in all these kind of cases, you will see similar yardsticks where employee cost becomes the biggest cost usually, and excise duty is not available, right? That's the key differentiation when you look at a services firm. It is always good to know these differences because India is honestly a service driven economy. Most of our GDP comes from services segment. So it's useful to understand because every other company we'll evaluate will be a services firm, right? You could add telecom to this list. You could add media to this list, right? So you could add hospitals to this list. All these are services firms. They're not exactly the same as each other, but they're in the business of basically dishing out services, right? So that's your services firms. That's when we kind of close this particular unit. Couple of quick questions. What is the biggest cost for a services firm like Infosys? And state any two differences seen between services and manufacturing firms' income statements. Thank you.